gentlemen, and welcome to this new Coface Group webinar, that will develop our latest economic updates on this very unprecedented period. More than a month has passed since our last webinar, and a lot of things are happened since then. First of all, the pandemic has developed in new geographies, especially in the Americas and in Latin America, while some other countries started or accelerated the process of de-lockdown of their economies, and we start seeing the magnitude and on the impact of this lockdown process and the virus into the real economies. So we have taken this time also with the team of Julien to reassess all our economic forecasts, because it was a fast-moving material to integrate. And I will leave the floor to Julien to present you our latest forecast for 2020 and 21, because we think that such a shock will have impact beyond the coming weeks in the world economy. Julien, the floor is yours.
Thank you, Nicolas. Hello, everyone. So as Nicolas said, I mean, you remember we organized our first webinar 2 months ago, then another one month ago. So we keep the pace once per month. If you remember, I mean, the first one was in early April. To be honest, we were all surprised by the fastness of the implementation of lockdown measures in several countries, mostly in Europe. So we were at that time trying to assess the magnitude of the shock during the lockdown. Then the second one, 1 month later, was more dedicated to the lag impact on emerging markets, because emerging markets were impacted with a lag. I will come back to it. And now, 1 month later, so 2 months after the first one, the situation has changed, as Nicolas was saying. We are now after lockdown in a lot of countries. So now the situation is a bit different. We need to better assess, let's say, the pace of the recovery, the slope of the curve. And the key point of this very short presentation before we move to questions and answers is that, of course, the pace of recovery will be very different from one sector to another. And point number 2, as Nicolas started to highlight, we are now entering a period in which we're seeing, let's say, more positive news at macro level, because the recovery starts. But we think there's going to be a lag between what's going on at macro level and what's going on at the microeconomic level, for various reasons. The first one is in all crises, there is always a lag between the macro recovery and the recovery for businesses. The impact on the micro side on businesses is always comes later. And the second one is this time is different. There have been, as you know, a lot of central bank government actions that came out very fast. So it postponed a little bit more the impact on businesses, but it will come. And last but not least, there is also some changes in terms of regulation, in terms of regulation of business insolvencies, especially in Europe, explaining why, even though we are going to see some perhaps mild positive news in a lot of countries regarding macro data, it doesn't mean the situation it will improve for businesses. So that's the key point of my presentation. Having said this, this is of course a sanitary crisis. So let's start with the basics on this side. You see the chart on this one. In most countries now, I mean, the peak of at least the first wave has been passed. You see it in all Western Europe countries. We go back to normal in a lot of countries, France, Italy. It's not the same completely in the US. You see it. All the more since the situation is very different from one state to another in the US. Of course, the pace is declining clearly in New York State, which was the epicenter of the pandemic in the US. But in some other big states, like for instance California, Texas, the picture is pretty different. So let's say the outlook at sanitary level first is more mixed and less clear in the US. And if you go to the bottom of the chart of the slide, you see some emerging markets where, of course, the trend is quite different. First, we have been surprised positively in some regions at sanitary level, not at economic level, but at sanitary level. For instance, in Central and Eastern Europe, governments reacted very fast to implement some lockdown measures, so it was very effective. In some other regions, I'm not even talking about Asia, but let's say Middle East, Africa, of course, population are younger, and population are also used to deal with this type of pandemic. And so far, at this stage, we're quite surprised on the upside. But as you know, and as Nicolas said, of course, there are plenty of exceptions, and most of them are now located in Latin America, where the pandemic continues to expand. You see it with the chart in Brazil, on Mexico, and it expands quite fast. It's also the case in Peru, in Chile, and this is now the key source of concern at sanitary level. Having said this, perhaps you remember, but last time we said, according to our baseline scenario, our forecasts are based. We assume that there will not be any second wave of the pandemic, which is a big if, because of course there is still a big chance that there is a second wave of the pandemic later this year. But you will see all of our forecasts are based on this strong assumption, meaning that if there is a second wave, we would have, of course, to downgrade a little bit more our forecast. So that's for the sanitary level, and the direct impact of that is, of course, that you know it. Now a lot of countries have decided to ease lockdown measures very gradually. So these lines here, this is aggregated. This is all data aggregated by Oxford University, and they assess the level of strictness of lockdown in each and single country. So to do that, they take into account things like school closures, public transportation closures, other restrictions, limiting movements. They aggregate all of this, and of course, if it's close to 0, it means there is no lockdown. If it's close to 100, it means there is a very strict lockdown. And the picture is very clear. You see it. Of course, you see that now lockdown are being eased, but we're very far from going back to normal. And this is the case for Italy, even for Germany, in a lot of countries. I mean, Japan, of course, in the bottom was a kind of a specific case because there were not such a big and strict lockdown measures. But in all other countries, let's say we are still very far from normal times. And of course, this is having a direct consequence on the real economy. Another way to look at it is this type of, let's say, new trendy high frequency indicators. I mean, they're trendy because first, there is no official data available yet. So we need to wait more to get the usual business confidence, industrial production indicators. So that's why those ones are useful. And they're also very trendy and quite useful because, as you know, this is a very unique and specific crisis, and so we need new types of indicators to better monitor it. And here you see what Google Mobility Trends data show in the US and in France. And the picture is the same as the one on the previous chart, meaning that, of course, the situation looks to improve a little bit, but we are very far from going back to normal. And the curve is not exactly the same in the US and in France. For instance, in the US, it decreased much less than in France during the lockdown, which is not so surprising because in the US, all states were not under lockdown at the same time. Okay, but in France, the point number 2 is that, of course, you went down, but now the recovery is a bit faster than in the US. But again, we're very far from normal times. And just to give you another example, which is not on this chart, is China. And China, obviously, as you know, the lockdown started much earlier. But again, still today, in Beijing and Shanghai, in terms of mobility, we're still 20 to 30% below normal times, which means that even 3 months after the recovery has started, it means we're still far from going back to normal. And so I come back to the key point of the presentation, which is, of course, the worst has been passed. Of course, now we start to see some more positive figures, but we have to compare them with normal times, and we're still very far away, and it will take a long time to go back to normal. So having said this, of course, the situation is very different from one sector to another. To try to have a clear and more quantitative view on a sector-by-sector basis, what we did is we looked at data of all listed companies all around the world. We aggregated them by sector, and we tried to assess, to make estimations of the impact on the turnover, of course, and also on the net debt ratio by looking at what happened in 08-09 in each and single sector. And so by doing that, you see this chart with all sectors represented by 1 point. And what you see is on the x-axis, our, let's say, estimation of the impact on the turnover of each sector during lockdown, so in the second quarter of the year. And on the y-axis, you see what is our estimated shock on the net debt ratio by using what happened in 08-09. And by doing that, and you put the points on a chart, you see that it's a pretty good picture, a pretty good proxy of how sectors behave during the crisis. And you can make some different categories with inside the orange bubble all sectors that are really into big trouble. And of course, we see here the transport sector. It's no surprise because we are in the middle of a mobility crisis. Of course, the situation is very different from one subsector to another. Airlines are much impacted. Other segment of the transport sector, like rail, road transport, and even maritime transport, a little bit less, and we can expect they will recover faster. But all in all, if we aggregate everything, the transport sector is, of course, much impacted. And then, in addition to this one, inside the same bubble, you will find a significant number of sectors that were already weak before the crisis. So just to name a few: automotive, metals, retail, plus, of course, energy, because of falling energy prices. So let's say that the sectors that are really impacted by the crisis. Having said this, you see another bubble in the middle, which, let's say, there are sectors that are in the middle of the pack. They are strongly affected, but I would say a bit less than the ones I've just talked about. They are affected in a second way and a bit less. And last but not least, so of course you will see construction chemicals here, for instance, usual sectors that are, let's say, in the middle of value chains, and they are not affected first, but then they are affected in a second way. Because I'm just talking about construction, so of course this is a global view for all sectors, but it doesn't mean there is no country by country difference in then. So for instance, construction, let's say this is the average view, but we saw, for instance, we were surprised that in some countries, the construction sector under lockdown did much better than in some other ones. And for instance, in France, the sector suffered much more than in Italy or in Spain, even though in those countries, companies had to face with the same type of constraints. And having said this, the last part on the right part of the slide, let's say I'm not saying that those sectors are not impacted, because all sectors are impacted by this high magnitude crisis. But let's say they are less affected than the other ones. Of course, the pharmaceutical sector, for obvious reason, in all crises, it does much better than the other ones. And this crisis is also a crisis which is directly linked to the pharmaceutical sector. So it's, let's say, less impacted than others. And the two other ones are ICT. In the short term, there will be, let's say, a significant impact on production coming from lockdown, for sure. But we can expect a quite fast recovery because this is a type of product we can buy quite easily when consumers restart to buy things. It's not like automotive, it's not like a real estate where, let's say, they are more durable goods, and we're more cautious when we want to buy this type of product. And agri-food, because even though here again, we have to look more at it into detail on a segment-by-segment basis, and some segments are suffering a lot, like for instance, the wine sector suffered a lot during lockdown, just to give an example. But on the other side, some basic products we need and we want to eat, and we want to make some inventories like rice or wheat, we saw a significant increase in prices, and on a lot of segments in this area, the trend was pretty good even during the lockdown. So this is a static view for the second quarter of the year. And the second step is, of course, then we tried to assess what could be the recovery after the lockdown and what could be the pace of the recovery even next year. According to our two scenarios I was talking about, the first one is there is no second wave of the pandemic, which is our baseline scenario. And the second one is there is a second wave of the pandemic. And in that case, we would have, let's say, a double dip recession starting from later this year and in early next year. And those two scenarios, we compare them with the scenario without any COVID-19 pandemic. So we have made forecasts by assuming there is no pandemic. And so, for instance, in some sectors, it means that there would have been some positive growth. In some other ones, like metals, for instance, the one you see on the top right of the chart, turnover, would have declined anyway, even without the pandemic, because the situation was difficult already. But of course, the magnitude of the shock would have been much less significant than the ones we are seeing at the moment. So for each and single sector, we have tried to assess first the magnitude of the shock for each sector during the lockdown, then the pace of the recovery after the lockdown, and the third one is at the end of the forecast horizon. So at the end of 2021, do we go back to the initial level? Because if we don't go back to that level, it means that in other words, it means that for this sector, this is not a temporary shock. This is a structural shock. and some production behavior, some consumption behavior are changing in the long term, not only in the short term. And this is, let's say, a kind of a new normal. So then, of course, we have used those assumptions on a sector-by-sector basis to make our forecast on a country-by-country basis by looking at the weight of each sector in the given country. And the outcome, you see it here on the left at global level, and on the right for each key economy. So the magnitude of the shock in 2020 is huge. You see it with double-digit decrease in production in 2020. It can look very pessimistic. If you remember, perhaps 2 months ago when we showed you our previous forecast, we looked also more pessimistic than the consensus. And in the end, 2 weeks to 3 weeks later, everybody moved on that side. Here, for instance, just to give you an example, if you look at the forecast on France, we used this sector-by-sector methodology 3 months ago to make our work internally in our files, and we came out with this forecast. And at that time, you could have said, okay, it's very pessimistic. And finally, last week, the government came out by saying it was revising down its forecast from -8 to -11%. And so it's also a good sign to show that this methodology and this approach works quite well, even though, of course, we have to remain cautious because there are still plenty of uncertainties. So then, as you know, we use this country-by-country forecast to make our business insolvency ones. Last time, what we showed is 2020 forecast. And as you know, usually we make forecasts on a yearly basis, on a calendar year basis. Here, the picture is a bit different because we think it's very tricky at this stage to assess exactly the timing of business insolvencies because of the reasons I highlighted in introduction, because of fiscal plan and government measures to help businesses. So to us, those type of measures, they are temporary, but it's difficult to know at this stage until when they will last. Second type of problem, changes in terms of rules, in terms of regulation of business insolvencies. For instance, in France, because of the emergency law, there will be a much less significant number of business insolvencies in the months to come, but we know there will be a lot more right after the end of the emergency law. So all in all, it means that because of the shock that happens in 2020, those business insolvencies could come up in late 2020 at the earliest, and even more likely in the first half of 2021. That's why we thought it makes more sense for us to show you our, let's say, expected increase in business insolvencies by the end of 2021, because we don't know exactly if it will happen in 2020 or 2021, but we know that the magnitude of the shock means that they will happen, even though on the previous chart, we also see that we expect quite a strong recovery next year. But this recovery, despite this recovery, at the end of 2021, we keep expecting that the GDP level will be, let's say, 2 to 5 points below 2019 one in most countries like the US, France, Germany, Italy, and so on. So the magnitude of the shock is really significant. And of course, since we expect quite a significant number of business insolvencies, plus 1/3 globally by the end of 2021, it means that it's also reflected in our country risk assessments, which measure, as you know, the corporate credit risk of businesses. So it's quite different from rating agencies, but you're familiar, you're very familiar with it. And all the changes you see, about 40% of countries globally, they reflect the trends we have described to you in the first two webinars, and in this one, meaning that, of course, a higher number of insolvencies, a significant higher number, plus a number of problems in emerging markets, even in markets that have managed quite well the sanitary crisis. So that's why you will see a significant number of downgrades, of course, in the emerging world, because as we highlighted last time, of course, a number of them will be affected by lower oil prices. A significant number of them will be affected by the fall in tourism revenues, and of course, it's going to last, even if borders reopen gradually. A significant number of them will be impacted by lower remittances coming from major economies, and this is also a big shock. And the problem is a significant number of emerging markets were already in a weak position before the crisis started. So last time, if you remember, I already showed this chart for those who attended the webinar. And what I said is the only one good news for emerging markets is that at that time, we were worried about capital outflows. And I was telling you that capital outflows usually in this type of situation, this is a knee-jerk reaction, but it doesn't last. So don't focus too much on countries that are only on the top of the chart. You have to focus more on countries that are on the right part of the chart, because now the key problem in the year, let's say in the 2 years to come in emerging markets, will relate to sovereign risk, because all of the shock I've just described will impact on the fiscal of emerging markets, and so a lot of them face a risk of default. If you want to know more about this, we published a paper on this, I think about one month ago, and of course, sovereign risk will increase further in emerging markets. Last but not least, global trade, of course, is also a source of concern in this type of situation, and is affecting a number of countries. We've seen quite a significant number of new things regarding trade protectionism in recent months, like some countries restricting exports of rice, especially in Asia, like Vietnam, for instance. Some other ones restricting export of wheat, like Russia, Ukraine, Kazakhstan. This is, let's say, the new form of protectionism in times of this crisis. It's like consumers going to the supermarket and buying four pack of pasta instead of one. This is a panic behaviors, but it is having an impact on global trade in the short term. And in addition to this, now we have also to think about the hold risks, which are coming back into the spotlight too. While we're exiting the lockdown, now we're rediscovering, let's say, the old world risk. And of course, you've heard about it in the news. There are renewed tensions between China and the US, and this is another reason why we can't be optimistic regarding the global trade outlook. Just to make it short, of course, the risk for businesses in the short term are the ones that were already up to date last year in this regard, because you see on the chart on the right that at this stage, China has not bought as much US good as it committed to last year, and that's the reason why that's partly the reason why the US president has changed his tone over the past weeks. And so we can't expect in an election period, as you know, in the US, any easing of the situation, we think, anytime soon. So this is also a big source of uncertainty for businesses. Having said this, you also know there have been plenty of comments, opinions regarding reshoring, regarding relocation in home country, and if we believe in it, this is the end of global trade in the short term. We don't believe in it. We think businesses that will try to relocate at home will not be numerous, because if you do that, you will have a problem of cost, you will have a problem of skills, and even if you manage to deal with cost and skills and you relocate at home, you will not reduce your exposure to abroad. Why? Because if you relocate some steps of the value chains, in the end, you will still rely on foreign countries related to commodities, because that type of product, of course, you cannot relocate it. So it's not a solution. Then the second solution could be to diversify your suppliers. And it's true that if you look at the situation on a sector by sector basis, you see it on the left. In a lot of sectors, of course, the top supplier is by far China. And so you could say, I want to diversify from China and to look at the top 2, top 3, top 4, top 5 suppliers to diversify my supplies. So it's a possibility, but the problem on this side is that if you look at global value chains, how they are organized, and you see the chart which is on the right, it's not so simple even to do that, because top suppliers, they're interrelated to each other. So if you want to switch from China to Korea regarding the chemical sector, for instance, on the left, you will see that even Korea trade a lot with China. So you will perhaps decrease a little bit your direct exposure to China, but you will on the other side increase your indirect exposure to China via Korea. So all in all, the good news on this side is that despite all you hear in the news, there is still plenty of potential regarding global value chain. So we're in the middle of a huge shock in the very short term. It will have an impact both in 2020 and in 2021 for businesses, but nevertheless, it doesn't mean the end of the world regarding global trade in the medium term.